Every fraction of a second, millions of calculations race through the servers of the global financial system. The volume and speed vastly exceed human capacity. From assessing a mortgage application to calculating the premium on a life insurance policy, the core underwriting functions of modern finance are now delegated to algorithms. This creates a direct tension. The logic executing these functions operates as a black box, yet its outputs dictate individual economic survival and shape broader market stability. The European Union has formalized its response to this reality with the Artificial Intelligence Act. The regulatory grace period for algorithmic financial underwriting has closed. The machine must now answer to the law. It is easy to assume the European Union would build a new standalone agency to handle this oversight, but that is incorrect. The AI Act does not isolate financial technology into its own silo. Instead, it embeds strict algorithmic classifications directly into incumbent financial law. The resulting architecture operates across three overlapping layers: a rigid classification system known as Annex 3, the existing financial supervisors, and established data protection jurisprudence. To navigate this, we must map precisely which systems are caught, which are given a pass, and whose jurisdiction they ultimately fall under. For fintech developers and compliance officers, market access relies entirely on mastering how these three legal frameworks intersect. The AI Act classifies systems by their functional use, rather than their underlying software architecture. Looking at this compliance stack, the first major trigger sits at the foundation. Any AI system used to evaluate creditworthiness or establish credit scores for natural persons is immediately classified as high risk under Annex 3. This rule targets individual consumer credit. It does not apply to corporate or institutional risk assessments. The second trigger slots into the exact category: AI used for risk assessment and pricing in life and health insurance. Landing in this high-risk bracket activates the Act's heaviest compliance burdens, including mandatory human oversight mechanisms and rigorous data governance protocols. These specific applications are caught because a flawed output in these domains leads directly to severe discrimination or the denial of essential life services. If a financial model touches a consumer's credit limit or their health insurance premium, it must carry the full weight of the AI Act. This high-risk classification is precise, and it contains explicit operational carve-outs for financial institutions. As we can see in our model, systems deployed specifically for financial fraud detection bypass the high-risk bracket entirely and land in an exempt zone. The regulatory logic here is straightforward. Fraud detection protects market integrity, so the law removes the friction of high-risk compliance to encourage its use. A second institutional exception sits right next to it: AI utilized for prudential capital calculations by banks. These are the internal risk models banks use to ensure they hold enough capital reserves to absorb sudden financial shocks. But there is a strict boundary on these exemptions regarding function creep. If an exempt fraud detection model is later used to adjust a customer's credit score, it instantly loses its exemption and violates the law. A system's regulatory destiny is entirely dictated by its functional intent. Mislabeling a model's purpose leads to immediate compliance failures. Once a system is classified as high risk, the question becomes who actually conducts the audits and issues the fines. The AI Act dictates that algorithmic risk management must integrate directly into existing financial law procedures. The law explicitly appoints the incumbent financial supervisor as the market surveillance authority for these AI systems. In practice, this means banking regulators, not new technology regulators, will be the ones inspecting the code and evaluating the training data. The European Union designed it this way so that banks do not have to answer to multiple conflicting regulatory bodies for a single consumer financial product. This creates an immediate need for financial regulators to upskill. They are now required to evaluate complex machine learning architectures alongside traditional financial metrics. For the financial sector, the AI Act is enforced from the inside. It is a highly technical mandate handed directly to their existing regulators. The final layer of this matrix is the unavoidable intersection with European data protection law. Classifying a system as high risk under the AI Act does not override a citizen's rights under the General Data Protection Regulation. The specific trigger here happens when a system makes a fully automated credit decision, immediately engaging Article 22 of the GDPR. Article 22 guarantees the right of a citizen not to be subject to a decision based solely on automated processing that produces legal or significant effects. This overlap brings algorithmic finance directly into the crosshairs of the Court of Justice of the European Union. We can see the weight of this in the landmark Schufa case law regarding automated individual decision-making. The Schufa ruling set a hard precedent. A credit score generated by an algorithm is considered an automated decision if a bank relies decisively on it. This severely restricts how financial institutions can use these scores. Developers must build systems that satisfy the AI Act's technical requirements while also guaranteeing the meaningful human intervention required by GDPR case law. An AI system can pass a financial supervisor's audit perfectly and still be struck down in court if it violates privacy jurisprudence protecting human autonomy. Looking at this integration stack, the regulatory landscape a financial AI model must survive is heavily interconnected. Credit scoring and health insurance pricing are undeniably high risk. Pure fraud detection and prudential capital modeling are explicitly exempt. Compliance is overseen entirely by incumbent financial authorities. Every automated outcome remains locked to the strict human-centric requirements of the GDPR and the CJEU. Legal and operational silos no longer exist. Legal counsel, data scientists, and risk managers cannot operate independently when designing these tools. Innovation in financial services requires engineering a system that simultaneously speaks the language of risk, finance, and fundamental human rights.